Okay. Um, I'll share this in the Discord, this Google Doc here, if you want to follow along with that. Um, First thing I was going to do is just talk about the different ways that people use breath. Is everybody hearing me and seeing my screen still before I get started here?
Yeah, we are seeing presentation with those 7 points.
Okay, cool. Um, this first tab here is one way that people look at breath that I see a lot. This is percentage of stocks above the 50-day moving average. Um, TradingView has a decent amount of breadth indicators, but not as much as stock charts and some other places. Um, that's one way people look at breadth. Another way, the advanced decline line. So every day, the number of advancing stocks minus the number of declining stocks. And I think they use all stocks. I can't remember how this one's calculated. No, this is NYSE. So this is the number of advancing stocks on the NYSE minus the number of declining stocks on the NYSE, and then each day they add, it's cumulative. That's how you get the AD line. A lot of people like this one. I guess I could go over some common uses. I mean, breadth divergences is what people look at a lot. So there was a clear one in September. I'm not wild about this kind of analysis because you can always look at a top and find a breadth divergence, but throughout an uptrend, you can draw a lot of these that fail too, but people don't draw those when they're looking back at it. Not my preferred way to look at it, although the AD line I do like, but I just prefer to look at it more quantitatively. I'll get into which kind of breadth that I use here very shortly. Here's another one, the McClellan oscillator. So the 19 EMA of advances minus declines minus the 39 EMA of advances minus declines. So it gets a lot more complex. Complexity isn't always better, in my opinion, but a lot of people like this one. And then the summation index, just it's the cumulative each day, just like the ADL. And this is what that looks like. And again, people just look for divergences. Yeah, I've not tested it extensively, but yeah, there's a big divergence here. However, I mean, this divergence went in for a long time. Like, when do you, is this the point where you get bearish, or is it this point? But then you have a positive divergence there. So I don't know. I'm not a fan of those methods, but that is what the majority, I think, use, is those sort of methods. Here's stock charts. You can look at this. This is just, there's just so many different breadth metrics on here that you could just look at. Like, here's all the ones for the Dow. All the breadth indicators for the Dow. There's lots of ways. You can look at 52-day highs minus lows. You can look at new highs, new lows. Lots of different things. I've talked about stock B a lot. This is, he just takes telecharts and scans for the number of stocks up 4% for the day and the number down 4%, then does a ratio of these two numbers in the last 5 days and the last 10 days. And similar stuff all down the line. He has, it's all automated. It's all populated, automated. The only problem I have with this is the data only goes back to 2007, although there is some older data, I think, possibly, and he's changed a lot of this over the years, so it's a little hard to get enough historical data to really test it. I have done some testing on it though, but not my preferred method still. Now, getting into what I actually use, this is the NYSE, basically advancing volume ratio. So what this does is you take the volume and up issues, divide that by basically the total volume. So the up volume plus the down volume. There's a little bit more volume in unchanged volume, but that's very small. And when you do this, you get a ratio from 0 to 1. So on Friday, 53% of the volume was in up issues. This kind of normalizes it for differences in volume. It's kind of my preferred way, although I've been looking at just up volume divided by down volume, and I think I may actually like that better, but I need to research that more, because I think when you look at it, up volume divided by down volume, it kind of accounts a little bit for high volume, like high total volume a little bit more, and gives those times a little bit more weight. So I can kind of show you what I mean by that. Notice how, because volume in and of itself has some value, and so this kind of accentuates those really scary times where we sell off hard, and you see just overwhelming up volume on a day that has high volume in general. Yeah, I mean, you could look at like total volume here. Turn this one off and see, I mean, yes, when we sell off a lot, there's a lot of volume, and that in and of itself can be somewhat useful. Although it's not that useful, it can be a little bit useful. So I think the up volume divided by down volume, I think might be a little bit more useful, because I think it just kind of incorporates the total volume aspect a little more. So that's kind of the ways I look at breath, but I've done a lot of testing of it, and I don't just draw stuff on charts as much as build out models based on this data and use those models to help determine the probabilities a little bit more accurately. Probably the best way to use breath, in my opinion, is on the bullish side, just like virtually everything, of course. So for that, this next tab is up vol divided by down vol here. You take the 3-day moving average of up vol divided by down vol. I need to get my scales right here. I think it is right. Oh, sorry, I got this wrong here. The up vol ratio, NYSE. So up vol divided by up vol plus down vol dot NY. And you see there's lots of different ones. Yeah, I still don't have it right, do I? Okay. Okay, that should be right. So the breath thrust concept. This is one way to look at it. There's a lot of ways to look at it. This is a 3-day moving average of the NYSE up vol ratio. What this looks for is we're looking for a 3-day moving average that's very low, falling by a 3-day moving average that's very high within a 90-day period. And that's how I define breath thrust. There's lots of different ways to define it. You can Google breath thrust, and there's just myriad different ways you can look at it. This is how I chose to look at it. So you can see, like, from here to like here, that's a breath thrust, and there's another on this chart. There's several. I mean, it's a little noisy when you look at the chart. But when you back test it, you don't get that many signals. But the signals you do get are extremely bullish. And that's breadth thrust. There's the entire length of time is above average when you see something like this. This is backwards for some reason, but we've had several in 2020. Yeah, out of the 2015-16 period, we had several. 2011, 2009 after that, and then of course there's some false signals. This one was early, because after that we had another dive where we took out the lows. But overall, this metric works extremely well, but it's a very rare signal, extremely rare. If you watch any of the Chris Chavacchio videos, however you say his name, he talks about it all the time if you want to see some more examples of it. This next chart is breadth divergences, why I think they're overused, because this is percentage stocks above the 50-day moving average again. You can see this breadth divergence.
Test.
Oh, I can hear you.
Oh, okay, good. Sorry.
Yep. This breadth divergence was for the entire uptrend, and then the entire uptrend, and the entire uptrend, because you have the breadth thrust, right? And then you're never going to get back to that level again until you have a major sell-off. That's why I don't prefer that method. And here's a back test kind of proving that point a little bit. So this is the SPX really extended above its 200 MA, and the NYSE up vol ratio is extremely low, so really poor breadth, and on the long term it's 200 moving average. So long-term breadth very poor, SPX very high above its 200 MA, and yes, it's a little bearish, but it's not tragically bearish. So again, breadth works better for buy signals in general, although
Those are all from 2009, right?
there's a lot of 09 in there. There's 08, 03, and then there was nothing for a long time, and then back. I have NYSE breadth data going back to 62. So a lot in the 70s. Yeah, so there's those repeat signals which do cause problems when you're looking at back
But
tests.
nothing this year?
Nope, we did not get this one this year. So, not this particular one. It does have a decent sample size, but overall it's not necessarily as bearish as you might think. However, here's one, gets a little more bearish, this next one. And again, we haven't had any this year either, but SPX is very near an all-time high, and the breadth is poor. It's below 20th percentile. And yes, it does get slightly more bearish, but still not wildly bearish. But this is an example, yes, breadth divergences do matter. Like, it does increase bearish probabilities a little bit, but it doesn't make bearish probabilities a guarantee, I guess is the point. Another way that I've been looking at breadth is uptick value. Now, let me go back and show you what I mean by that. I've found this uptick value to be maybe a little better than volume. So what this does is look at the value of stocks that are on an uptick and adds that up for the whole day. And then the value of stocks on downticks adds that up for the whole day. And then you can put that into a ratio like we did with this other. And I found it to be pretty good. I kind of think of it in a way as like when you look at the indexes, like equal weight versus equal weight versus cap weighted. So that you could think of this like a cap weighted breath almost. This is kind of adjusting a little bit for the value. So if your mega caps are going up a lot, it's going to drastically increase the up value versus the volume won't be as big because a lot of your bigger volume is going to be in small stocks. So if you're looking at volume, you're looking more at, you're giving more weight to the smaller stocks. If you look at value, you're giving more weight to the large stocks. And I found this to be very useful. So let's get that turned on. Okay. So it's noisy, of course, but when you start to test this guy, you get some really interesting things. And this is one of the tests. So this would be like a more of a short-term type of breadth divergence. Using that metric that I just shared, and it gets a little more bearish. And it still has pretty good sample size. Now, your median and your percent positive are still positive. It's not a, like, let's rush out and short, but it's just a risk reward becomes skewed when you see these things. You don't necessarily want to be making new entries. If anything, you want to probably be reducing size a bit. That's all this is saying. It's not saying world's about to end. And here, this next one is just an example of kind of blow up top breath, I guess is how I defined it. So this is an example of breath can be too good, right? So SPX closed above its upper Keltner channel, which for me, that's 2.25 ATR 20 EMA. Can I show you guys that? I guess, let me just show you Keltner's real quick that I use. I've shown it many times before. I'll just show it real quick here just so you see it kind of visually. So 2.25 ATR multiplier, true range, 20 EMA. And when you do this, you get very few closes above the band. And so you don't get a lot of closes above the upper band. So it's kind of a rare signal, and it's a signal of fairly extreme overbought conditions. And you compare that with certain types of data like breath and some other data, and you can get some fairly interesting signals. And so that's what we have here. So this is a little bit more useful of a kind of breath indicator. Last time we saw was this June, where we really got it. We had that kind of gamma ramp. We find the right one here. Was this one? Yeah. So you had this kind of gamma ramp here, and it just, yeah, the breadth was extreme. There was just extreme buying across everything. And once if people are buying everything at an extreme rate, basically you can just trap longs. And that's kind of what happened there in June. Just everybody got trapped. Those are the kind of the ways I use breadth. I'm going to have more on breadth in the future. And then in my book, there's going to be a very large chapter on breadth. I'm not finished with it yet. I'm kind of putting everything together. But these are some of the things you'll probably see, some of these back tests and some of this kind of data. And I guess I'm done with my part here. If you guys want to have any questions or want to talk about it, I guess now's the time.
Do you look at the volume, cumulative volume over exchanges? For example, as a confirmation of an up move or some sort of divergence, whatever.
Volume, you're talking about the volume, just the regular volume?
Yeah, the regular volume, like, but not from just futures, but from all the exchanges that can be derived.
I haven't looked at it. I mean, I do look at it, but I haven't really looked at it quantitatively, I suppose. But like I was showing earlier, this T-vol gives you all volume for all US stocks. So you can put that on. And like I was saying, yeah, it can be a signal. But I think you have to pair this with some other stuff. I think it's difficult to use just this. But clearly, high volume tends to be more bullish than low volume. I think a lot of people look at it. I think the perception's changing a bit, but low volume tends to be more bullish. People always complain about low volume rallies, but that's normal. When you start to see high volume in a rally, that's not good usually, like here, for instance, although it's noisy. Even here, we had to go sideways for a long time after we did that. And same here. I mean, we just went sideways. And I'm kind of zoomed way out, so it's probably hard to see, but yeah, total volume. This takes total volume across all exchange. Certainly could be something that could be useful, and probably is something I should look at more. But just like with everything, works better for buy signals than sell signals. That's just how it is with SPX. Man, look here, we had very high volume and we just sold off a bunch. Anytime you sell off a bunch and you have high volume, it's not always like a surefire place to buy. Because if you had bought here, I mean, you had to go through a little bit more pain. Long term, yes, it can be a good place to at least start to consider buys. Although, me, I like to see price kind of move up a bit. And I'm looking at these areas more than I am trying to catch this. And then the other thing about this, like especially back here, if you look at DIX really turned on once we started to rally. And that's something we saw back here too. This is where DIX got excited. It's not so much down here, right here. That's where the DIX went crazy. That's where the COT dealers started getting heavily long down here, but they were really long once we got to here. That's where you should get interested. If you, like, for instance, here's an example where you don't necessarily just want to buy because volume's high and we dumped a lot. And yes, if you would have sold, you could have made a lot of money here, but then high volume, I mean, you would have really got dumped on. So it's not a signal by itself, but combined with other factors, yeah. I mean, we had a huge sell-off and we had a lot of volume. And that's typically bullish. It's just, there can be a delay.
Right. So looking at this, one thing that I'm thinking about, I think you alluded to that it's hard to look at the breadth divergences and find tops. Mm-hmm. But what if have you looked at breadth divergences plus volatility spikes? Especially looking for more of those periods of the 5 to 10% drawdowns as a place to maybe do some hedging.
Brett, are you talking about implied volatility or realized volatility?
Implied volatility. Realized volatility is often behind the curve.
Yeah.
So, just something that comes to mind looking at this, because whenever I look at, what's a signal for a top, thinking about, forget February and March of 2020, because obviously that was a crisis. Hopefully we never repeat in our lifetimes. Mm-hmm. Thinking about even going back to 2019, what might have signaled the divergence in May and August, in otherwise very bullish year, and they're definitely, I recall both those periods pretty well having, I wasn't looking at breadth, but I do recall both those periods where at the end of July and at the end of April and beginning of May, we started to see volatility creeping up in advance.
Oh, right. Yes. Yeah. That was another, that's a,
Implied volatility. So just, just the VIX. So if the VIX is starting to creep up
yeah.
and breadth is starting to diverge and both those are now diverging from price, how is that a reliable signal? Have you ever looked at combining those two?
Oh, yes, definitely. Definitely. So yeah, especially you can look at, say, correlations between
Right.
VIX and SPX, and yes, you start to add that factor in. And I have actually found VVIX, the volatility of the VIX,
Right.
to even work a little bit better. Yes, definitely. That can be, if you add that in with breadth, you add that in with weakening dicks, you add it in with, COT positioning and other sorts of positionings extended, then absolutely it can be definitely a factor. This is something that I have started to research more, is the correlations between VIX, SPX, VVIX. I've done quite a bit of research on it already, but there's a lot of false signals. But it's fairly rare to, especially when you look at VIX. Now you can get positive correlations between VVIX and SPX a lot more.
Right.
But when you look at just VIX, yes, it's a red flag. It's not necessarily bearish every single time. But September, we definitely saw it. We saw it return on the ramp up, and then October. And we saw it recently, and it was kind of, at this point, it's been a false signal.
Yeah.
We saw it very briefly in January, and it can be early, but correlations between VIX and SPX are very rare, positive correlations. When they do happen, it can definitely be a red flag. I mean, just look at the last few times we saw it. January before Volpocalypse. Nearly happened in October. I'm looking at the 20-day correlation, by the way,
Right.
VIX and SPX. You saw it in May before a pretty good sell-off. I think that was 8%. Yeah. A bit early in January. But yes, that's definitely a signal. I think I've linked it before, but there's this volatility tsunami white paper that Thrasher wrote. Yeah, this one. Very worth reading through this. Kind of where I got some of this idea. Although the way he's looking at this is he is looking at very low VIX. And of course, before major declines, we sometimes see the VIX get very low.
Right.
Meaning nobody's hedging, voluntary risk premium is very low, all that kind of stuff.
Well, I haven't looked at that paper, but I have seen, volatility will get very low, and that will often precede, maybe like a 3 to 5% pullback.
Mm-hmm.
But I mean, I'm not really that concerned about 3 to 5% pullbacks. Those are super healthy.
Yeah, definitely.
But even 2019, which was a great year to just be and hold long, we had a couple really big pullbacks. And if you could have, I usually try to use those. I just want to try to buy the bottoms or near the bottoms and add leverage. But if you could, create a positive return on those type of pullbacks with some hedging or just, even a rotation into safety, that could dramatically, change your long-term returns as well.
Absolutely. Absolutely.
Of course, I think everybody would say that, and everybody would call that the holy grail.
Right. Yeah. And it's extremely hard to nail all that.
And if you spend all your energy and money hedging every false,
right,
every 3% pullback, you'll decline. Your returns will decline, not improve.
Absolutely will. Yeah.
So
yeah, you can't hedge everything. I don't believe in being hedged very often unless I really am concerned. I got a little concerned recently when we did again have that positive correlation and some other factors, but a lot of that has subsided, at least for now. So, it's hard to say. We can talk anytime, but I'm not seeing necessarily as many signals firing off all at once as we've had at some other tops, at least recently.
No, I mean, I'm in the still long-term bullish camp.
Yep. Well, that's where I am. So I've stayed that way for quite a while.
Which doesn't mean I don't suspect we will have the, several pullbacks in the 8 to 10% range in the course of 2021.
Mm-hmm.
But I can't tell you when I think those will occur, unfortunately.
Yeah. It's hard. I mean, all you can do is kind of try to formulate probabilities of that. And when you get ticks at weekends a lot, when you get major breadth divergences and you get these fixed correlations and other factors, that just slowly increases the probabilities. But yeah. I think you can combine you have to combine a lot of things before your probabilities get above 50% when you're talking about this particular market.
Yeah. I mean, and like I just think it's easier if you're concerned, if you're leveraged, to pull back leverage, or if you're not leveraged, just to take some off.
Yeah.
But never just totally exit. And then, if you do that, you might have to be patient, but then wait for that pullback and be willing to buy.
That's exactly the way I approach it.
And ignore the 90% of Twitter that is always declaring the end of the world and willing to bet against the guy who can land a rocket ship in the middle of the ocean on a small pad.
I'm with you, man. 100%. 100%.
So I guess, and one thing, I think I've mentioned this before on your Discord. That guy, Marston Parker.
Mm-hmm.
So he just launched a release of his software. I've been actually working with that, and really, following his advice, trying to develop ideas more like an automated system trading individual stocks on a mean reversion basis. So a long short portfolio.
Mm-hmm.
Mean reversion stocks, and that has a positive expected return and non-correlated to the direct the movement of the S&P 500.
Yeah, I remember he was in the stock room, and I do remember that was his thing, was mean reversion. So he's been studying that for I mean, I'm guessing 15 years. That's kind of been his thing, if not longer. So if you learn from him, you will learn a lot, because he's been doing it for a long time.
I find his software is really good, actually.
Yeah, I could see it. I've never used it, but I could see it because the guy is so knowledgeable. So
he's super nice as well. And,
yeah.
So he's been really helpful, and I've been actually live testing on a small portfolio, something I developed using his software. So I'm kind of hoping that meets my back test. So a lot of things back test well, and then live trading maybe not so much.
Yeah.
But I think I followed the right steps in back testing it.
Yeah. Back testing is troublesome because there is a lot of pitfalls you can get into, and it's very easy to make a back test look really bullish when in reality it's not. So,
well, yeah. So I did design my rules empirically and not through data mining, and and so out of sample it tested better than instant
blow off tops before any 8% corrections, and it seemed to be a little bit related to gamma getting very high and some other stuff. But did you do any comparison when we got them earlier on, or what was diverging or lining up before the blow off top signal was produced?
Yeah, I mean, I haven't done extensive testing, but I do know June in particular, being a Spot Gamma subscriber, they the market ran way ahead of all the options OI levels when we had that gamma whale they kept talking about. Um, Combine that, like we also saw, it showed earlier, the VIX correlations were very positive. There was um, VVIX and VIX correlations are another way you can look at it. So if you see VVIX moving ahead of VIX, that can be a warning sign. But I've noticed that's a very, very, very noisy one. But um, that's the other thing about Zoom is I wish I could just admit people automatically. I wish it would just do it automatically. Um,
Accidentally left.
so sorry. Yeah, that's one thing that we've seen on blow up tops. I mean, I think the blow up tops that we have seen in the last few years, you kind of saw one in June. Um, you saw one in late September for sure. I don't really consider February a blow up top. That was just kind of a slow melt up.
October was also similar before we
Yeah,
got this.
October was the same way. We had some positive correlations on VIX, VVIX, and we got ahead of options levels again. Spot Gamma was noting the same thing again with that. And of course, the apocalypse was a blow off. That was a major blow off top in 2018. I think that was one of those things where you knew it was going to end, but you just had to wait for price to confirm. And if you didn't do that, you could have. There's many places you could have just sold, and ultimately it would have been a sell kind of above where it ended up or just barely above where it ended up bottoming out. Like you didn't gain a lot. That's right. That's right. That's one of the times where I learned that you don't preemptive sell. Like in this market, you wait for some sort of price actual breakdown um, to actually change your positioning. And I've found that just that simple idea has saved me so much potential lost trading income from selling way too early. Yeah, but that's something I want to research more, and I do need to research the VIX uh, more in terms of VIX correlations, and I think that's where you can see a lot of potential issues with blow-off tops. When we move way ahead of the options OI levels, it just removes all the support from the market. Because when you're way ahead of those calls and you're way ahead of puts, so puts basically your gamma is like down to nothing. But then when you have a really big down day, all of a sudden them puts that them dealers that didn't even care about because they're so far down, and the gamma and delta is basically nothing. Well, you have a big dump, all of a sudden implied volatility skyrockets. All of a sudden them puts are in play. And then the new puts that are added on are just driving it further down, and that's where you have you have all those trap buyers. The other thing I was talking about with blow off tops, and I mentioned it earlier, is sometimes you have just breadth get extreme. Like I had that example I showed where breadth was extreme. And last time we saw that was in June. We had just extreme breadth to go with kind of a parabolic move higher and close above the Keltner channel. That's another thing you can see. Go
Could you
ahead.
explain what a blow off top is for me? Like what is it?
It's just a top that where price accelerates extremely fast and kind of gets ahead of itself. I mean, I think a blow up top is a little bit more. I wouldn't say anytime a market gets parabolic, that's one of the few times where I think there's a fairly high probability of bad things happening. Like if a
Have you seen
market's
Bitcoin?
Yeah, right. Yeah.
It's going parabolic.
Yeah. Anytime a market does that, the ending is like never like calm. Like we're just going to go sideways now on Bitcoin and it's just going to be like happy at this price. Like eventually when that thing tops out, it's going to be parabolic to the downside for a while. Just like, SPX doesn't get that parabolic, but
Like, look at the daily chart on Bitcoin.
Yeah.
Would you say that's parabolic? Yeah, like
it's
if
extremely
you look at the
parabolic.
1 hour, it's like you can see it going parabolic then coming down. But if you look at the daily, it's just straight up.
Yeah. To me, there's some major shenanigans going on, but
Love that word.
so we'll see on that one. I have no
So
idea.
what example were you gonna say? You said
Well, on SPX, like June, for instance, we printed 1, 2, 3, 4, 5, 6. Yeah, pretty much every bar, like 10 bars in a row, was green, damn near, and you had multiple gap ups. I mean, that's parabolic. And for SPX, that's parabolic. But that can go on for a long time. I mean, look at, like I said, look at the Volpocalypse. That went on for how many days in a row? That same exact thing. You just never know how many days it's going to go on for. That went on for 20 days in a row, or just straight up gaps, 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 and you just never
people
know.
are jumping in front of it, in front of the steamroller.
Yeah, I mean, everything was pegged to the max in terms of sentiment and breadth, and it's just eventually you're going to have a top. You just don't know when and where, but you do know eventually you're going to see a top, and it's going to get a little bit nasty usually. I mean, it's very rare that I've seen a parabola like end like calmly. I think it just doesn't happen.
If that option seller guy, optionsellers.com guy, didn't like blow up on natural gas, I think he would have blew up during the Volpocalypse.
Yeah, he was just getting too crazy with it, man. And it's like, the other thing is, I think anybody that their whole business model is selling vol, I think if they don't have some sort of method for getting flat, just getting completely into cash at a minimum, I think your risk of ruin is just very high. And it may take 20 years, but eventually it's going to happen.
Oh yeah, that's the business model. There's a chance that the chance was always there that you could blow up.
Yeah.
It just happened to happen.
Yeah,
And
exactly.